It's Tom Altieri, New Jersey Mortgage Services. Maybe you can stop renting. I put together a video on FHA mortgages. It'll give you a little insight to what they are and how they work, and it may be something that'll help you stop renting and buy a home of your own. Now, if you stay till the very end of the video, at the end I'm going to tell you a spot where you can find very affordable houses throughout the state of New Jersey. Okay, watch the video, enjoy.
In this presentation, we're going to talk about what your best mortgage option might be, and that just might be an FHA low down payment mortgage. What does FHA stand for? Well, it's the Federal Housing Administration. It's a part of the government under the Department of Housing and Urban Development. So what's important for you to know is FHA does not give out mortgages or lend money. What they do is they insure loans for lenders against default. Now, who can benefit from an FHA mortgage? Well, borrowers with low down payments, borrowers with credit blemishes, borrowers with high debt to income ratios, borrowers who really don't have a lot of their own money and need sellers to help with the closing costs. And we'll go through these in a moment. Now, with a low down payment, the guidelines for an FHA mortgage is you need 3.5% down payment. So an example would be if you were borrowing $200,000 or you bought a property for $200,000, you need $7,000 down payment. That would be 3.5 times 200,000. Now, for those folks who don't have the $7,000 in savings, guidelines allow a gift, and it can be from a family member, it can be from an employer, it can be from an acceptable charitable organization, it can be from the government or local housing grants. Now, one of the other benefits of a FHA mortgage is, they allow for not perfect credit. So below average credit scores are more than acceptable. You can get an FHA mortgage with a credit score down to 580 without any additional down payment. What I mean by that is FHA mortgages will allow to even go lower, and some lenders will lend down to 550, 560, but they'll require a 10% down payment instead of 3.5%. FHA allow judgments, collections, and other delinquent obligations. They don't automatically disqualify you for that, but in most cases, they'll have to be brought current. Now, cash to close. Sometimes, borrowers really, they just have about enough money to buy the house with the 3.5% down, maybe a little bit of money in reserve. What FHA allow you to do is allow the seller to pay up to 6% of your actual legitimate closing costs and prepaids. Closing costs, for example, would be your attorney fee, your title, recording fees, items such. Prepaids would be your escrow account, prepaid interest. Now, an example of a borrower who may be looking to borrow $200,000, they may need, and this is just for example purposes only, these are not the actual costs, they may need $5,000 to $8,000 in closing costs and prepaids. The nice thing about an FHA mortgage is this can be negotiated as part of the contract. And let's do an example of that also. So you look at a house and the borrower or the seller wants $280,000 for the property, and it's worth $280,000, but in part of your negotiating you say to the seller, hey, I'll give you $280,000. I only want to pay $275,000. So therefore I want you to take $5,000 out of that $280,000 and use it towards paying my closing costs, my true and actual closing costs and prepaids at closing. That's how you can negotiate some of the closing costs into the contract. Now, higher debt to income ratios. Now, with FHA insures loans, they'll allow borrowers to have higher debt to income ratios, and the term in the industry is DTI. Now, there's two ratios. There's a front ratio and a back ratio. The front ratio would be your new mortgage payment, your monthly mortgage payment, principal, interest, tax insurance, and mortgage insurance, and you would divide that into your gross monthly income, and you'd come up with a front ratio. And then you'd come up with a back ratio by taking that and also adding your other debt, for example, car payments, student loans, or any other debt you may have. You'll add that into the new housing payment and divide that into your gross monthly income. Now, in some cases, with FHA mortgages, you can have a front ratio as high as 47% and a back ratio as high as 55%. And I've had some lenders do that. Whereas if you go into conventional financing, the ratios are somewhere around 36.43. Generally up to 45 on the back end can get an approved. If you need to go higher than that, you really need some good compensating factors, and Fannie Mae and Freddie Mac or conventional type financing will go up to 50 with good compensating factors. Other than that, FHA, is the place to go if you have high debt to income ratios. The costs associated with an FHA mortgage is mortgage insurance, and there's two costs. One is the upfront mortgage insurance, which that premium is 1.75% of the total loan amount. And I do an example here. If you had $120,000 or $200,000 mortgage times 1.75%, the mortgage insurance premium up front would be $3,500. The nice thing about FHA is they'll finance it into the loan amount, so the amount of your total borrow would be $2,035. Then there's an annual premium that has to be paid, and that's 0.85%. And what happens there is that's paid on a monthly basis. So if you took $200,000 times 0.85 and divided by 12 months, you'd come up with a monthly premium payment of $141.66 on a $200,000 loan. Something to remember on an FHA mortgage, the annual or the monthly never goes away. At one time it did go away when the loan, or after 60 months. Conventional financing, when the loan drops below the 80% mark, it can go away. But now with FHA mortgages, it stays through the life of the loan. So let's just recap the benefits of an FHA insured mortgage. First and foremost, low down payment, as little as 3.5% down, it can be a gift. Marginal credit, blemish credit, it's going to be acceptable. Rates are usually lower than conventional financing, which is great because it'll compensate for the additional charge in PMI. So with a lower rate, it'll offset that PMI. Now with conventional financing, they have huge adjustments, especially, for example, if you had a low credit score. Let's say your credit score was around 640 and you're putting 5 or 10% down. They're really going to bang you up with adjustments for rate. Whereas with FHA, your rate's going to pretty much remain the same. And last but not least, if you can afford a higher debt ratio, you can take on a little more income than Fannie or Freddie or conventional finance will allow. FHA.
Hi, it's Tom. I'm back. I hope you found that little video informative, and just maybe you're starting to think, maybe I don't have to rent anymore. Maybe I can buy a house. Well, you're going to find a little link after this video, or you may find one right in this video, depending where you're watching it. What I want you to do is click on that link. We'll provide you a pre-approval to help you determine whether or not you can qualify for an FHA mortgage. It's no obligation. And also, what I'm going to have for you on that link is when you go to that page, I'm going to have a little button for you, and that button's going to take you to a place where you could find super affordable houses throughout the state of New Jersey. In the meantime, if you have any questions, I'm always accessible. 732-239-1642. Tom Altieri, New Jersey Mortgage Services.
Who is eligible for a VA loan? From bestindiemortgages.com and Jim DeCamp. Wartime conflict veterans. Veterans who were not dishonorably discharged and served at least 90 days. World War II veterans, serving from September 16, 1940 to July 25, 1947. If that's you, you are eligible for a VA loan, and you should contact Jim DeCamp to talk about your options. There are other types of conflict that are also eligible. If you were in the Korean conflict, June 27, 1950 to January 31, 1955, or the Vietnam era, August 5, 1964 to May 7, 1975, you too can apply for a VA loan. Who else is eligible? If you're in the Persian Gulf War or the Afghanistan and Iraq conflicts, check with the Veterans Administration Office, as you too may be eligible for a VA loan. Now what if you're not listed? Contact the Veterans Administration website at www.va.gov. Now, peacetime service. At least 181 days of continuous active duty with no dishonorable discharge. If you were discharged earlier due to a service-related disability, you should contact your regional VA office for eligibility verification. July 26, 1947 to June 26, 1950. February 1st, 1955 to August 4th, 1964, or May 8th, 1975 to September 7th, 1980, enlisted, or to October 16th, 1981, officer. Enlisted veterans whose service began after September 7th, 1980, or officers whose service began after October 16th, 81, must have completed 24 months of continuous active duty and been honorably discharged to get the VA loan. What about reserves and National Guard? Certain U.S. citizens who served in the armed forces of a government allied with the United States during World War II are eligible. Surviving spouse of an eligible veteran who died resulting from service and has not remarried, also eligible. Or the spouse of an armed forces member who served active duty is also eligible. Call us for free mortgage help. That's Jim DeCamp's number, 317-507-5494. Again, free mortgage help, 317-507-5494. Or go to Jim's website, bestindiemortgages.com. Give old Jim DeCamp a call. He's a veteran and he wants to help all other veterans out there get their loans.